Hey everyone, welcome back to Corporate Decoder. Today, Titan Acquisition Corp filed an 8K, and I'm seeing a major shift that could impact shareholders. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing details a big business combination, and there is a crucial investor update that could change how the stock performs. So what we are looking at here is a current report from Titan Acquisition Corp. Think of this as a company announcing a really important business event. The big news is that Titan is entering into a business combination, which is basically a fancy way of saying they are merging with another company. This is a pretty common move for what are called SPACs, or special purpose acquisition companies, which are companies created just to buy other businesses. Titan Acquisition Corp, or TACHW as it is known by its ticker, is a Cayman Islands exempted company. This means it is incorporated in that jurisdiction. It is essentially a shell company set up to find and merge with an operating business. The date of this report is the 1st of June 2026. And that is the date of the earliest event they are reporting, which is the signing of this big agreement. The core of this filing is the Business Combination Agreement. This pact lays out the terms for how Titan will combine with OpenPayd Global Holdings Limited. It is signed by Titan, OpenPayd, and the shareholders of OpenPayd, along with a few other parties involved in the deal. This agreement essentially describes the whole plan for bringing these two companies together. So how does this combination work? The agreement states that Titan will merge with OpenPayd Global Holdings, which they call PubCo. After the merger, Titan as a separate company will cease to exist, and PubCo will carry on. In exchange for their existing shares, Titan's shareholders will get shares in PubCo. On top of this, PubCo will also buy all the shares of OpenPayd Holdings Limited, making OpenPayd a wholly owned part of PubCo. This is a pretty standard structure for a SPAC merger aiming to take a private company public. Now, let's talk about what people get for every share of Titan they own. A shareholder will get one share of PubCo. However, Titan's public shareholders also have the option, as is typical with SPACs, to get their shares redeemed. This means they can choose to get their money back from Titan's trust account instead of taking PubCo shares. The warrants, which are like options to buy shares later, will also convert into PubCo warrants with similar terms. Essentially, the deal values OpenPayd at about $800 million US. This $800 million will be paid out in PubCo shares. However, there are some transaction fees that will be subtracted from this amount. There is also a specific payment to a company called Ann Martina Limited, which is referred to as the company advisor. They will receive their transaction fee in the form of PubCo ordinary shares. The number of shares they get will depend on the fee amount and the redemption price of Titan shares. For this deal to go through, a bunch of approvals are needed. PubCo will file a registration statement with the Securities and Exchange Commission, or SEC. This document, which includes a proxy statement and a prospectus, is basically the official paperwork that tells investors all about the deal. Titan shareholders will then get to vote on this merger at an extraordinary general meeting. If the majority, specifically at least 2/3 of the votes cast, agrees, the deal can move forward. Like most big contracts, this agreement has standard clauses called representations, warranties, and covenants. These are promises made by each party about the information they provided and how they will behave before the deal closes. For example, there are rules about how Titan, PubCo, and OpenPayd must run their businesses until the merger is finalized. Importantly, these assurances don't last forever. They generally stop applying after the deal closes, except in cases of fraud. Now, for the deal to officially close, several conditions must be met. These are like checkboxes that need to be ticked. For instance, governmental approvals must be obtained. The Titan shareholders need to vote yes, and no laws can be in place that would prevent the merger. A key condition is that PubCo shares must be approved for listing on the Nasdaq stock exchange, and the SEC must be happy with their registration statement. Also, there shouldn't have been any major negative events affecting Titan, PubCo, or OpenPayd since the agreement was signed. Both sides have to confirm their promise statements are true and that they have fulfilled their obligations. A critical number here is that the total proceeds from the deal must reach at least $130 million US, after accounting for transaction expenses. This agreement isn't set in stone forever. There are several ways it can be called off before it closes. Both Titan and OpenPayd can agree to end it. If the deal isn't completed by the 31st of December 2026, either party can walk away. Also, if a government body steps in with a final order blocking the merger, it is off. Either company can also terminate if the other seriously breaks the agreement, unless that breach can be fixed. If the shareholder meetings happen and the votes aren't enough to approve the deal, that is another way it can end. The deal can also be terminated if the minimum proceeds amount of $130 million isn't secured. Along with the main deal, several other agreements were signed on the same day. This is common practice to ensure all parties are aligned. One of these is a transaction support agreement with Ozan Zerk, who seems to be a key shareholder of OpenPayd. He agrees to vote his shares in favor of the merger. Then there is a similar agreement with the sponsor. Titan Acquisition sponsor Holdco LLC and other warrant holders. They also agree to vote their Titan shares and warrants in favor of the deal. The sponsor also agrees to pay back Titan for any costs related to previous potential business combinations. There is also an amendment to a previous letter agreement with the sponsor. This adds a new section about vesting and forfeiture for a portion of the sponsor's shares called purchaser earnout shares. These shares will only become fully owned by the sponsor if Titan's stock price reaches certain levels. Specifically, 50% vest if the stock hits $11.5 for 20 trading days within a 30-day period, and the other 50% vest if it hits $13 under the same conditions. These conditions are also applied to the PubCo ordinary shares the sponsor will receive. This is a way to align the sponsor's interests with the long-term success of the combined company after the merger. The sponsor support agreement also mentions again that 50% of the sponsor's shares will be subject to these vesting conditions. They will become fully owned if the stock price reaches $11.5 or $13 for a certain number of days. The newly issued shares in PubCo by the sponsor will also be subject to these same performance conditions. This part is interesting. To get the key shareholder, Ozan Zerk, to agree to terminate another agreement, the sponsor will give him over 1 million PubCo ordinary shares and a significant number of private warrants. What is key here is that these specific shares and warrants given to Mr. Zerk are not subject to the same performance-based vesting conditions as the sponsor's own shares. This suggests a sweetener to ensure full cooperation on the deal. There is also a non-competition agreement signed with the key company shareholder. This means that after the deal closes, for a period of 2 years, he cannot compete with the combined company. This is standard to protect the business from its former owners immediately trying to start a rival. This filing also highlights a liquidity event plan that PubCo will set up before closing. This plan gives certain shareholders who hold Class B and Class C shares in OpenPayd the right to sell back some of their PubCo shares. They can sell up to 15% of their shares at $7.5 per S-share. But there is a total limit of $10 million for all these repurchases. PubCo also has the option to buy back shares at $12.5 per S-share up to 15% of a shareholder's holdings. This is essentially a put and call option mechanism designed to provide some liquidity for these specific shareholders, while also giving PubCo control over how many shares are bought back. And as if that wasn't enough, they are also approving an equity incentive plan. This means they are setting aside a pool of PubCo shares to grant to employees and key personnel as a form of compensation. The pool is set at 10% of the total shares that will be outstanding after the merger. They plan to file specific forms with the SEC to make these shares available for grants. This is a standard way for public companies to attract and retain talent. A lock-up agreement will also be put in place. This is where major shareholders, like those holding over 5% of the company, agree not to sell their shares for a certain period after the merger. This is crucial for market stability, preventing a flood of shares from hitting the market right after the IPO, which could drive down the stock price. A new registration rights agreement is also being put in place. This agreement essentially gives certain shareholders the right to have their shares registered with the SEC, allowing them to sell them publicly in the future. This replaces an older agreement related to the sponsor. And finally, there are subscription agreements. These are agreements where outside investors called PIPE investors agree to buy shares of Titan immediately before the merger. This is a common way for SPACs to raise additional capital and ensure the deal has enough funding. They are also working on getting agreements from current shareholders who promise not to redeem their shares, ensuring more money stays in the company. This section relates to Regulation FD, or fair disclosure. Basically, it means that when companies release important information, they have to make sure everyone gets it at the same time. Here, Titan is announcing that they issued a press release on the 1st of June 2026 to announce these transactions. They've also attached an investor presentation that will be used to talk to shareholders and other interested parties about this business combination. These are furnished materials, meaning they are provided to the CC but not officially filed, in the same way as the main report. This is a way for them to share information broadly without triggering certain rules. This is a standard but very important part of SEC filings. What they are doing here is warning investors that some of the statements they are making are not based on historical facts but are actually predictions about the future. They use words like believe, may, will, and expect to signal these are forward-looking statements. They are saying these predictions are based on their current expectations and assumptions, but actual results could be very different due to various risks. The risks they mention are quite broad, covering things like the possibility of the deal falling apart, legal issues, not getting shareholder approval, changes in laws failing to meet stock listing requirements, and disruptions caused by the merger itself. Essentially, they are covering themselves by saying that while they hope for the best, a lot of things could go wrong. This section is crucial for anyone interested in the deal. It reiterates that this document isn't a solicitation for votes or offers to buy or sell securities. Instead, it is an announcement. They are telling investors to look out for the official registration statement on Form F-4 that PubCo will file. This document will contain all the detailed information about the transaction, and investors are urged to read it carefully. They also point out where to find these documents on the SEC's website. This part emphasizes that the list of risks they've provided might not be exhaustive. There could be other problems they haven't thought of or don't consider significant right now, but which could still impact the company. This is a standard legal disclaimer to protect the company from liability if unforeseen issues arise. This part identifies who might be considered participants in the process of getting shareholder votes for the merger. It usually includes the directors and officers of Titan. They are essentially saying that these individuals' connections to the company mean they might influence how shareholders vote. They provide a way for investors to find out more about these individuals through other SEC filings. This is a repeated disclaimer. It is important because it clarifies that this report is not trying to persuade investors to buy or sell stock. It is purely informational. They are stressing that this document itself doesn't constitute an offer to sell or a request to buy any securities. Any sale of securities would need to follow proper legal procedures, like registration. This section lists all the exhibits attached to this filing. These are the supporting documents that provide the details for what is discussed in the main body of the report. Things like the business combination agreement itself, the support agreements, amendments, and press releases are all listed here. This is where you would go to find the actual legal documents that outline the deal. Here we see the full list of exhibits. The most important ones are probably Exhibit 2.1, which is the business combination agreement, and then the various support agreements and amendments like the key company shareholder support agreement and the sponsor letter agreement amendment. There is also a press release and an investor presentation. Notably, the exhibit index includes symbols like the section sign and the dagger. These indicate that certain parts of these exhibits might have been redacted or omitted, often for confidential business information. The company agrees to provide these omitted details to the CF requested. Finally, we have the signature part. This is where the company officially signs off on the report. Frank Mastrangelo, the Chief Executive Officer of Titan Acquisition Corp, has signed this report on the 1st of June 2026. This signifies that the company stands by the information presented in this filing. So, what does all this mean for investors? This filing signals a major step forward in Titan Acquisition Corp's journey to merge with OpenPayd. The key takeaway is that the merger is now officially outlined in a definitive agreement. However, there are still many hurdles to clear, including shareholder approval and regulatory reviews, the earn. Our provisions tied to stock performance for the sponsor's shares suggest that management is keen to align incentives with future stock performance, which is a positive sign for long-term value creation. On the flip side, the numerous termination conditions and the reliance on shareholder and regulatory approvals mean the deal is far from guaranteed. The historical context for SPACs post merger often shows significant initial volatility and a tendency for many to underperform their initial valuations, especially for smaller SPACs. For example, many SPACs that merge with companies valued around the $800 million mark have seen their stock prices decline by 50 to 70% in the year following the merger. That means for every $1,000 invested at the merger price, investors have seen their holdings shrink to $300 to $500. The success of this merger will heavily depend on OpenPayd's ability to deliver on its growth projections and navigate the public market. The risk I am watching closely is whether the required minimum proceeds of $130 million can indeed be secured, as failure to meet this threshold is a direct path to termination. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hit that like button, subscribe for more, and check out the Discord for insider discussions.